All right, everybody. Hey, we are back after that great presentation by Larry. But you've heard some people speak about our next speaker here. This guy is somebody we've met just recently over the last, I guess, probably about the last 7 or 8 months, maybe a little bit longer than that, as we are always looking for good vendors. And his name came highly recommended from somebody else, and we put a deal with him. And some of our students have done some stuff, and we've just been just so excited at what he and his team are doing. They really are awesome at what they're doing. He's also an investor. He's the head over at Covey Financial, just down I-35 in San Antonio, Texas. But also one of the principals at Sombrero Funding, I believe, which is a huge tax lien servicing company as well, like that. But I'll let him talk about his magic and what he's focused on and how he is putting the service back in loan servicing, because there's a big need for that, and not every servicing company is created equal. So for you guys that are looking to have notes and are tired with your servicer or looking for a new servicing company for a first deal, you're going to want to take a lot of notes, and I guarantee that Eric Covey won't let you down. But Eric, we're honored to have you here on Note Camp. I'll let you take it away and we'll go from there, buddy.
Thank you so much. Yeah, appreciate the intro. Let me share my screen here. And yeah, Scott, you're right. I mean, I think it has been, even though it seems like a long time, it's probably only been about less than a year. So
Right.
It's been great to know you and great to be involved. And, your students have been fantastic. I know we've worked with several, and, it's been a pleasure. So absolutely. And, today, I know I've got about an hour to talk about, loan servicing, and it really is, I think the way I kind of describe loan servicing to people and kind of what we do is, closing loans, acquiring loans, buying loans, like that's like the fun stuff. It's really a lot of fun. And the servicing, there's moments where it's awesome, but it's really kind of, it's like a really I think integral part of any loan, to do things correctly, to deal with the borrowers correctly, to manage a portfolio correctly, to handle things that arise correctly. And it just takes a lot of thought, I think is the nice way I'm going to put it. It takes a lot of thought and effort to do it well, and consistency. And, it's hard. And, when people don't pay, you got to reach out to them, and it just, you got to deal with certain, life happens to people, and you got to be flexible and tough. And it really is a difficult aspect of loans. But what I want to talk today, and I kind of just one thing, and I know we're chatting here, so please, I'm an informal person, so anyone wants to chat, a question, like, please don't hesitate. Can you see my screen, Scott? I didn't even ask. I'm sorry, Scott. Can everyone see?
Yes, we can see you. Okay. Muted it. Yeah.
Great. Sorry. So as I go through this, I've got my email here, and if anyone just doesn't want to chat, you can shoot me an email. All of the slides will have my email here at the bottom. And you're welcome to, one, our website is just coveyfin.com, but two, if you want to message me directly, I welcome it. I answer my emails literally 24/7. I know I've got some emails to Larry late at night some nights just because I'm maniacal checking my emails. But what I'm going to talk about today is just kind of background on me and the company. For a lot of note investors, loan servicing is kind of like an afterthought. Like, most people don't think about the importance of loan servicing and what it means, and really what it is. I'm going to talk about the pros and cons behind outsourcing it. I mean, for some people it makes sense to do it yourself, and for some it doesn't. I'm going to talk about a lot of things that I've done I've done personally, and I've seen a lot of people done personally, like some avoidable mistakes you can make as note investors to be sure to not do. I'm going to talk about escrow formulas. This is one where I think a lot of people just, even in my industry, like I deal with people who just can't explain how to calculate escrow. And I think this is just one to just, every time I'm going to be with you, Scott, I'm going to talk about it just because I think it's so important. And I'll talk to you a little bit about our pricing and how we work, and then I'll conclude and just open any questions. But that's kind of my agenda for today. So first and foremost, me, I'm pushing 40, and, I graduated from the University of Denver. I have a background originating in loans for myself, and that's kind of how I got in the servicing business, and I'll tell that story here in a minute. But my Sombrero Capital company, we've originated since 2012 over 8,000 tax liens in Texas. It's been a substantial ride, and it was kind of combination of we're originating so many $10,000, $15,000 loans. You really have to do a process much like a real estate loan. You order title, you get docs reviewed, you have a closing with the borrower, you get the documents back, you got to fund, you have to send the payments to, you have to actually fund and close. And, we were doing the process on a high volume scale for many little loans. And, one of the things that I first invested in was, hey, we got to get some really good software to do this and to manage it right. And that was, one of the integral pieces early on that got me in the servicing business. Funny story, the reason I really got in the servicing business is because my mortgage company, my servicer pissed me off so bad. But I had a mortgage back, my first loan house I'd ever bought in 2011. I had my first time buying a house. And at the end of the year, I called the servicing company to say, hey, just want to make sure you pay my taxes. I'm on escrow. Just want to make sure everything's cool, right? Everything's okay. And sure enough, my servicing company said, yeah, no problem, Mr. Covey. You've got enough money. We're about to cut the check. Great. So like the next month rolls around and I have this $25 fee on my statement. And I'm like, hey, when in the world is this? And I called back to my servicing company and I said, hey, I'm on automatic payments. What's going on? Like, what's this fee? And they go, Mr. Covey, we charged you a $25 fee because you called us. And I was like, you got to be kidding me. Like, I didn't say kidding, but you got to be kidding me. Like, just because I called, asked, they're like, yes, sir. And I'm like, are you charging me now? They're like, yes, sir. So like for $50, I started a servicing business because I felt, the way, and I did some research, the way these servicing companies and these, lenders treat servicing, I thought was just so wrong and just, so fee driven. And it was just like, it was ruthless. I felt like it. And I thought there's got to be a better, friendlier way. And I'll talk about our pricing later, but it was really a combination of the high volume we were doing in my sombrero business in unison with, them pissing me off enough that I thought it wouldn't. It led to do what we do now. But in addition to tax liens, I also have and I'm anyone who's interested in like raising money. I've been in private equity and I actually have 2 hard money real estate funds that I currently manage, and we've originated over $25 million in commercial real estate loans in the last 3 years. So that's been something I could help out with. And in the volume that we do in these 2 businesses, I've been involved in purchasing and selling loans. And I think the largest one we ever did was 1,200 in 2019. And in 2018, talking about due diligence, I know Larry gave a great presentation on, what to look for and how to do things. And, I'm happy to be a resource to anyone, but I was looking at buying a company in 2018 that had almost 4,000 loans. And it turned out that company, lied through their teeth. Their assets were held by a receiver. They had no right to sell the loans. And it was a big giant mess that we spent a lot of money on that turned out bad. But I've been involved in a lot of purchase and sales. Private equity, I talked about fundraising. And, one thing I've also done a lot too of is I've received a lot of bank loans and I've been denied a lot of bank loans. Dealing with banks can be very challenging and tough, and presenting a portfolio, real estate portfolio, lending portfolio could be very advantageous with some bank leverage where you can borrow money at 4 or 5%. But this is a little bit more complicated. But I have some experience with that if anyone needs help. Background on the company. So the company, in 2012, after I had that mortgage story, that's when I started Covey Financial, and it slowly grew. We started with, people who knew that we had good software, and eventually it's gotten to be that, we serve over 60 clients in over 15 states. We're adding a few right now. And our current portfolio of mortgages is over 6,000, which we're really proud of. And, we service loans for private investors, individuals. We service loans for several companies like private equity firms. I think our private equity client that we service tax liens for has about 2,000 of our loans. Like they're one of our biggest clients. We service a lot of nonprofit loans. We service a lot of loans for Habitats for Humanity and the Fuller Center disasters. And I service loans for several governments in Florida, which has been nice. And it's been a great experience to do that with them. And in that, since 2012, we've got a great experienced staff. We got CPAs. We got a network of vendors. I mean, it's gotten to be like a system, which has been nice. So that's background on me and the company. And I think I want to talk a little bit about, for lenders, for people who are buying notes, what exactly is loan servicing? And I think, I tried hard to make this concise and simple. And like, one of the most difficult things was, how I can put this very briefly and keep it to 1 hour. But what is loan servicing? A lot of people just have no idea. And I mean, in a very simple way, the administration of a loan between a borrower and a lender. And, when note investors buy loans or, transact, it could be that the note investor, for a variety of reasons, wants to either do it themselves or outsource it. But a lot of borrowers feel more comfortable that there's a third party with no financial interest in the property and the loan, like just for like a flat fee, just says we'll administer the payments, like receive them, let them clear, then disperse them. And the way we do things is, if a borrower pays once it clears after 7 days, we'll release the funds to the lenders. So the lenders for us get money fairly quickly, along with statements and all. But then, so just this is like a very simple way of saying it, but like there's a whole lot more deepness that goes into it. So management of loan payments and terms after closing. One thing that I've learned in this business is there's actually there's various ways to calculate interest. There's a, do you do 365 days in a year? Do you do 360 days in a year? Or do you what banks do, which is a 365, 360, which is like effectively a higher rate than advertised. So that's like 3 interest rate calculations. In Canada, there's actually a unique Canadian amortization way of doing it, which is something that we learned recently. We don't service any loans in Canada, but if you ever, people along like Michigan and up in the northern states may have something appear in Canada that you got to be careful on Canadian amortization, because apparently it's different. I'm not familiar with it, but apparently that's something to keep an eye out for. But like, one of the things that we do, and I think this is really important when you are diligencing a deal, or even like preparing your documents with your attorney, make sure you get terms in there that can actually be done, or that either yourself or your servicer can do. And the simplest one is 365 actual days in a year. Like, hey, if you charge 12% interest, and there's 31 days in May, that's how it actually works. Where if you say, hey, there's only 360 days in a year, every month has 30. And February is one where people get mad in. Well, hey, there's only 28 days, but you charged me 30 days. It's like, hey, that's just what the docs say. It's 360, and this month you got penalized a little bit more, but overall it's that's the way it works. So the management of loan terms, it sounds simple, but it's a little bit more complicated than it sounds. And also the proper application of payments pursuant to the terms. So back to what I said about how many days are calculated in the promissory note and how the interest is determined, you got to make sure the system applies it. And if you just do it in Excel, I believe Excel, Excel assumes there's actual days in a year, where if you have like a 360 year or a 365, 360 interest calculation, Excel may not be accurate. So when payments are applied, you got to make sure, hey, actual days are determined. And you also got to make sure you're not violating any local or federal laws. And what I mean by that is, I can't tell you, Scott, how many loan documents I have seen where like certain things are like illegal. Like I'm not going to use the word illegal. I'm going to say not right. And a good example is a lot of states have certain grace periods. Like I know Texas, at minimum, you have to have a 10 calendar day grace period. And I've onboarded loans and I've seen the documents say 5 days. And it's like, no, you actually, it's great that your documents say that, but this is a residential loan. This is the law. And, we're going to make it 10 days to conform. Right. And then some states have 15, and and that's just about grace days. A lot of states have rules on how much you can charge for late fees and NSF fees and all sorts of different things. And you got to make sure that whatever you do on someone's loan not only gets applied correctly, but conforms with all laws. And also too, applying loan payments, I think a lot of people think it's like easier than not, but there's a variety of loan payments. There's like a regular loan payment. There are irregular loan payments like interest only, extra to principal, only to principal. Like there's irregular payments that arise that like, you have to apply correctly. And the most complicated way of ever thinking about payment application is if your loan ever falls into bankruptcy. Bankruptcy law is so complicated that we have network of attorneys we work with, and the problem with bankruptcy and payments are there's no uniform way. It's really, you have to read the bankruptcy case one by one and apply the payments as the judge requires. So it's really like anything you think about payments before gets thrown out the window in bankruptcy. You have to like literally follow what the judge says. And also, and it's extremely complex. And hopefully if y'all ever buy a loan or in bankruptcy or falls into bankruptcy, I highly recommend, making sure you have a really good attorney that represents you as a lien holder in the case. And we have a network of people who need that. So in addition to these first two things, the next big thing that servicers do and what they need to do is maintain accurate records. So records include all the payments, whether they're regular or irregular, all the event logs, like calls that come in, calls that go out, all the statements that you send out, whether they're regular payment statements, late notices, NSF notices, delinquency notice, whatever it is, like you have to maintain those records accurately, because a lot of people don't know this. Servicers and even lenders who do it themselves, but servicers get audited. Like I get audited from time to time by certain state regulatory agencies, and they come and inspect all of our books. They look at everything we did. They'll say, hey, why did you charge an NSF fee on this person? Well, we'll say, well, look, they mailed us a check, it defaulted, or it didn't clear, here's the transaction. And you have to literally have like the world's biggest paper trail. And especially when you're talking about residential loans, just because the CFPB and the rules are only getting more and more consumer friendly. They protect consumers, not us, the commercial lenders or the commercial servicers. So maintaining records, I mean, this is one. I mean, also too, like loan files, you gotta, one of the things that we do is every time we onboard a portfolio from our clients, we make sure the loan documents are in there, all the closing documents, anything that we, the insurance documents, the tax, anything that related to the loan, we have to make sure we hold on to it, because, you have to, every loan is different, every term is different, and you got to like look at them and make sure everything matches perfectly. And anything that you send to the borrower needs to be maintained, and anything that you say to the borrower needs to be like recorded or saved somewhere in like a log. Servicing also includes, compliant and proper notifications to borrower for certain events. I have a lot of note investors who, think that they'd like us to do things differently. Like we notify people of their payments 10 days before they're due. And I've got some people who tell me you need to do it differently. And it's like, look, trust me, this is compliant, it's fair notification. And like, we can't harass people. You got to give them a notice of when their payments due, notify them when they're late. And then you can start calling them after about 25 days. You got to respect some privacy to some degree for some of these people. And it's hard for some lenders because this is money that you expect, and we're well aware of that, but we can't control when people pay and don't pay, and we got to at least be compliant and not harass people. But notification's a big one. You got to make sure that's consistent. You have to send a monthly invoice for their payment statement. And the way we do it, we send it via regular mail, email, and text message. We send someone a trifecta of notices like, hey, Scott, in 10 days, your mortgage payment's due on the 1st. And then, after they miss their grace period, we'll send a late notice the same way, email, regular mail, and text message like, hey, Scott, you missed your payment. Now you got to pay this. And then around the 25th, we send them like a formal delinquency notice. And then we also we do a 45-day and a 90-day certified letter, and that's compliant. Back to, going on the next bullet here, collecting and dispersing funds properly between borrowers and lender. Like, this is one that sounds so simple, but depending on how much P&I you get, principal and interest, based on the payment application, you got to make sure that that's properly dispersed. You got to make sure that the borrower, whenever we do the end of year 1098 forms and the lender 1099 forms, like, the interest being applied correctly to the correct lender, to the correct borrower, allows us to do all of our end of year tax reporting properly. So collecting and dispersing funds is so huge. I mean, that's like the most integral part of what we do. And that's where we spend a lot of time on making sure our system's accurate. The next item that we do, and this is probably repetitive, but processing and crediting the payments, it's synonymous with what I just said, that you need to receive the payment. You have to actually post the payment, and posting the payment includes two things: registering in the servicing software, which applies a principal and interest, reduces the loan balance, and does what it does, moves the next payment. And you also have to deposit it. And a lot of servicing companies get in a lot of trouble lately, because what they'll do is they have these lockbox services, in Phoenix or who knows where, out in the middle of out in some other distant place. And, people will send payments. They will be received and deposited in their bank account, like, on a certain day. But the servicing company doesn't get the report from the lockbox bank until like 2 weeks later to post it to the loan payment. So there's like a 2-week period where someone logs in online, their payment has been pulled, it's been deposited, but they're showing up as late. And depending on the timing, maybe their credit reporting shows them as negative. And it's like a huge problem for servicers. And we had to fire our lockbox during the heat of COVID in about April of 2020, just because it got so bad that we get the mail here in San Antonio, just because, hey, if we grab a payment and we're going to deposit it and post it in our system the same day, so we don't have these bizarre lags. And this is, even though it sounds like something I talked about before, it's a little bit different, but it's similar. Another one thing that servicing companies do is, in addition to like statements, communicating with homeowners early when payments are missed to help them avoid falling further behind. So what we do is we call people around, if their payments are due on the 1st and they haven't paid, by the 20th, we call them. The rules say you got to call them by I think it's either 31 or 36 days, according to the CFPB, but we call them much earlier because, one, we don't get paid our servicing fee until funds are collected. So we're incentivized to call people, but we're friendly about it. But two, we know our clients, they'd value that we do more than the bare minimum. So we try and call people early to get them to pay. Because if they call it 31 or 36 days, then they're 2 months behind. Where when we call them at 20 days, they're still just 1 month behind. But you got to make sure that, especially these last couple of years with COVID and everything in the world going on, people being laid off, it's been a challenge to make sure that homeowners get contacted early and, they get set up with some type of option. Options include, we can do an informal arrangement. Hey, Scott, you're 2 months past due. Your payments are $200. You owe $400. Why don't we pay $100 a week until you're caught up, or $150 every 2 weeks since you're caught up? We do a lot of informal arrangements, and it's been successful. If someone is really in a bind, loan modifications is one that we recommend our clients do. And I don't know if Larry's still on this call or not, but I love this story about Larry, where he sent us his first loan. He bought a non-performing loan in South Carolina, and the borrower was with a previous servicer who shall be left unnamed. And the borrower, I looked at the payment history, and he was making payments for the last 24 months fairly timely. I'm like, that's a really good sign. That's great. So one of the things that we did is we made a welcome call to this client, and that's what we do for all loans, but we made a welcome call And we're like, hey, we see that you want to be on ACE automatic payments. That's great. We see that you're 3 years past due, but you've been paying. Have you ever thought about a loan modification? And the guy was like, look, I've been begging my previous servicer for years. I need that. And Larry, you know, paid a fraction of the loan balance. And, this worked out really nice for Larry, that he ended up having a fresh start to a brand new loan that's performing, and it's, very valuable now. So loan mods aren't necessarily bad things for people who don't pay. And it really just depends on what the circumstances are for the loan. And if you see like any recent paper trail of payments, a loan mod is a great way for a note investor to buy a loan at a discount and improve the face value of the note by making it a new performing, brand new, badass loan. So that's one of the scenarios that works out really well. But for people who can't pay and just struggle, and they've got a good story and it makes sense, and we've seen like a level of effort, I think every person deserves at least one loan mod. But we've got clients who've done it, burned our client, and just end up being foreclosed on just because they just took advantage of something nice. Short sale, none of my clients have ever been involved in a short sale. And for those of you who don't know what a short sale means, that would mean if, the lender would have to take a loss in order for the borrower to sell the property. And I think these things happen very rarely, and they shouldn't happen. And it really has to do with like what the value of the property is, what the LTV of the loan is. And I think a lot of people would make a mistake by, not requiring any money down from a borrower to buy a property. So like if you give them 100% financing, and then some for like closing costs and other things, and they put no money down, they got no skin in the game, short sales could arise because maybe you lent too much money against the value of the property. A deed in lieu of foreclosure, we've done a few of these for our clients where the customer or the borrower just says, look, I just can't afford this property. It's over, I'm like in over my head. I just want to give it back to the lender. And a deed in lieu of foreclosure is what happened in those situations. So borrowers who fall behind, we have to give them several options because we service, the CFPB requires that we have to give them options, but just because if they apply for a mod or something, doesn't mean the lender has to approve it. The criteria for underwriting and diligence must still be met. And yeah, let me keep going here. I hope y'all are still there. I know I've been on a monologue here for a while.
You're doing good. You're doing good, Eric. I was going to say, short sales sometimes will come in handy too if the neighborhood has dropped down. And we, depending on how far behind, we've bought some stuff that we bought such a big discount off the UPB, and then the bar was trying to sell it, but the previous bank wasn't responsive. Like you said, the previous servicer wasn't responsive. And when we moved it to somebody new, we're like, oh, you want to do a short sale? Okay, what do you want to sell it for? What can we sell it for? And talking to the realtor out there, like, well, we got a cash offer at this. Like, let's do it. Let's just go, because it's a win-win there at the point to get in and move on. But yeah, we haven't seen many of them in the last few years. But with some of the stuff that we're seeing, I would be surprised if we see some more of those over here the next 12 to 24 months.
Oh yeah, I heard a Zillow stat. I mean, San Antonio is a hot market, just like Austin. Like I think San Antonio is now the fastest growing city in the nation. But I heard an interesting stat here that home prices on Zillow have averaged dropped 15% in the last handful of months. And I'm sure other states or cities may be similar, maybe worse. Austin, Scott, you're probably not experiencing that because Austin's so crazy. But short sales arise in rare scenarios. But you're right. If you as a note investor buy something at a cheap enough, at a discount, a short sale may be the biggest win-win for everybody. Yeah, absolutely.
Like my neighbor literally across the street, he bought at the peak. So he paid $550 for his house. Well, comps now are not at $550 or $575. I think it's maybe what he paid. It's more at $500. So if he, that's going to take a little while for that to come back to get where he was based on comps in the market. But it is what it is. If he rides it out, great. But if something happens and he loses the job, he's upside down by $75,000. You know what I mean? And
absolutely.
That's you see, I talk to a lot of short sale agents because that's kind of one niche that we target for potential distressed debt. And they're seeing an increase definitely in Dallas and Houston, especially on that like 500,000 price range or above, they're seeing that starting to sneak up. A lot of builders are slashing their prices because their buyers are walking away. That's not really a true short sale, but it kind of is a little bit. You know what I mean?
Yeah, and I think to me, this is so rare. Maybe for you, Scott, if anyone ever thinks about this or has a question, I think just email Scott or somebody or I, and we'll happily help you. But yeah, these things don't happen often. I think a lot of them happened in the '08 financial crisis with the falsified appraisals, but now in the real appraisal world, it shouldn't happen. Okay, so yeah, good to know y'all are still there. I hadn't heard from anybody in a while, so that's good.
You're good. You get some love on YouTube as well. All right,
good,
you got
good
some.
deal.
You're good. We're good. We're loving it.
Let me go ahead and continue here. So another thing that servicers do is, and it sounds strange, but relationship building between the borrower and lender. I gave an example on Larry, how we kind of helped, the financial relationship there, but we try to be like middlemen. So for instance, as much as we can, sometimes we've got clients who want to call the borrower directly and like, I don't know, ask them a question, who knows what, or deliver bad news like, hey, you've been denied your loan modification. Like we act as intermediaries between our client and our lender, because sometimes if they interact directly, it gets a little hostile, and sometimes borrowers will plead and just not accept no for an answer. And it helps us just keep the relationship professional. And I mean, I think this next topic for me, I mean, I can't tell you enough how escrow is important for loans. I mean, this is one where, this could be a seminar in and of itself, but properly managing escrow for accounts and their calculation, I think is one of the biggest reasons why I think people should hire a servicer. The way liens work, where property taxes, I mean, insurance lapses, and even there's other things like HOA bills. Like, I mean, there's so many things that can supersede a deed of trust or a mortgage, that I think just by simply collecting escrow, whether it's for property taxes, insurance, or HOA, not only protects the borrower, but ultimately protects the lender, you guys here on the class. And I honestly would never advise anyone to not like to disallow escrow. Like if you have a loan, like escrow should be required, no ifs, ands, or buts. And if you can't afford the payment with escrow, it's a bad loan. And like, think about that. If you want to do a loan at 10 or 12%, but they're saying, man, but that escrow payment of 500 or 800 bucks for the taxes and insurance, I can't afford, don't do the loan. Because if they can't pay it, what makes you think they'll pay it later, without escrow? Without escrow, just kicks the can down the road and it just makes a big mess. But servicers handling this stuff is like, I think the biggest reason why, why people should hire a servicer. I'm looking at the question here. You're talking about if we are going to originate a loan, right? Yeah. So I'm going to chime in here, David. So requiring escrow, as a lender, you can dictate when you originate the loan. However, if you, like, let's just say you buy a loan, and let's just say the loan's in default, right? Like they're past due on payments or who knows what. A modification, well, you call the customer and say, look, I bought your loan. I'm your new lender. Let's talk to you about getting you on the right track, right? And that's like the greatest way to reach out to someone and just be like, look, I'm your new lender. You sound reasonable. Hey, I want to work with you. You're past due. How can we get you a fresh start? By the way, let's agree to your payment start in, I don't know, September 15th or September 20th, but I'm going to require escrow. So it depends on how you buy a loan. But yeah, you can dictate terms easily when you originate loans, but when you buy a loan, depending on the circumstances, you can probably modify it to it. And also too, when you buy loans, if they don't have escrow accounts, this is where, I mean, like I've had a background of buying loans and I've helped some of my clients, look at stuff on diligence items. If you buy a loan that doesn't have escrow, that should be like a red flag to you, like go check the taxes, request a proof of insurance. Like the lender should have it. And if the seller doesn't have it, they should contact their borrower for proof of insurance. And, it's going to be hard to change the terms if you buy a loan, but if the loan's current, if the insurance is in place, if the taxes have been paid for a while, that's probably a fairly good trust. But without escrow, you need to keep your eyes on it. And I know we do insurance monitoring, we do tax monitoring, and we can tell pretty early on if someone's delinquent on their taxes. So David, I hope I answered your question there. And if I didn't, please shoot me an email. I can explain that in greater detail. So let me look here. Carolyn, you're asking me, what are the fees for doing workouts with bars? I'm assuming this is an extra cost. So here's what I'll say. If we do like an informal payment arrangement, like, hey, Carolyn, start paying $100 a week, we don't charge anything. And we don't practice law at my company. And what I would recommend, this is what I recommended to Larry, the loan modification that he did, Larry and his attorney did it. We don't profit, or we don't make any fees or doing, like, I'll talk to you about how we price ourselves here later in this presentation, but we don't charge anything for workouts. The loan modification shall be done between the lender and the borrower, and I recommend the attorney prepares the docs. And you're better off spending $300 on legal fees and paying a servicer a couple hundred. We don't charge anything, but if a servicer charges stuff, I think it's wrong, but some do, but we don't charge anything. Rob Stokes asks, please clarify, you say HOA supersedes. So homeowners associations, I know this in Texas, and I think these are state specific rules. You can definitely check your state, but in Texas, if you don't pay if there's a community with a homeowners association and those HOA fees are unpaid, like they're not very much, like what, $500 a year, $1,000 a year. If those things aren't paid by the property owner, that will supersede the lien position. It's a special HOA lien in Texas, and they have the ability to foreclose in front of you. There's rules that they have to notify you, and a lot of them do, but it's something to seriously consider. And Rob, I hope I answered your question. And one thing I'll say to you about lenders, I'm going to talk about some common mistakes, but I have a great relationship with my attorney, and we talk all the time, and we've negotiated flat pricing. Like, hey, if I order docs, it costs me X. If I call you with a question, you don't charge me. Like, but I order a bunch of stuff from you, and you just flat pricing. And your attorney is going to be a great resource to what the local laws are. I mean, I don't trust realtors. I don't trust other lenders. I want to hear it from the attorney who represents my best interest, and that's the best way to get rules clarified. And spending a couple $100 on an attorney might save you tens of thousands later. Well, good. I hope I answered these questions here. And if they and feel free to keep them rolling in if you have any more. Okay, talked about escrow accounts. Credit reporting, we report to the 3 credit bureaus. There's actually, I think, 5. There's TransUnion, Experian, Equifax. There's Innovis, and there's a new one. I can't remember the name of the new one, but there's technically 5, just so you know. But a lot of borrowers, if they're good payers, reporting them positive to credit's great. And if they're bad payers, they get penalized. So credit reporting is a big one, and I think it helps lenders get payments if they're going to pay.
I think it's a great bargaining tool, because we've bought stuff where it was owner finance and somebody wasn't paying for it to be credit reported. And if we find out that had been reported a lot of times, especially non-performing, we've had bars like, listen, if you start paying on time, we'll start reporting to the credit bureau. That'll boost your credit score.
Yeah.
And in 12 months or whatever, you can get refinance out of this if you need to. I think that's a thing that people don't recognize. That's actually really, really valuable. Not every servicing company reports to all 3. Some will report to 1, and that's about it. Yep. So that's a huge bargaining tool, I think, in good and bad, for folks that like, oh, I'm going to get refinanced. Well, you've been reported credit. No, you're not going to go get a traditional mortgage or refinance me out for 24 months. So let's do a deed in lieu or a short sale or something like that. So yeah, I'm glad to hear that you report to all 3. That's awesome, Eric.
Oh yeah, no, credit reporting is great. And I mean, again, I think it keeps the bad actors away, and anyone who's on the fringe of being a good actor becomes good. So credit reporting is great for lenders and note holders to consider when getting service. I get a question here about transfer of servicing your company. Transfer of servicing is actually really easy. Maybe let me know what states these loans are in, but the transfer process, we've done so many of them that data is provided by the previous servicer, and then we got to notify the borrower about 15 days prior to the transfer date. We'll sign a servicing agreement, and then we'll get final data on the transfer date, and it's really easy. But what I would recommend to that is, we got to get a pay history from the previous servicer, a full pay history, any itemization of charges that are on there, and a copy of the loan documents, and we'll be good to go. But yeah, it's really easy. Let me kind of get through this here now that I'm actually worried we're running out of time. So next part of this is implementing compliant and sound policies. And this sounds so simple, but it's huge. I mean, there's a lot of companies out there that have cease and desist orders from state regulators. There's a lot of companies out there that are unlicensed. I mean, just dealing with like the basics of being licensed, compliant with local laws, doing things soundly according to the CFPB and doing it consistently. Like, you'll be surprised if you start Googling, one of the things that I do in my free time that gives me a lot of amusement is just I just Google my competitors and reviews, and I love seeing the things they do wrong. So definitely look into do that whenever you consider someone. And again, consistent processes. That's I think the biggest thing. A lot of people who bring loans to me that they've done it themselves. It's hard for the lender to go on vacation, answer the phones, get statements out consistently if they do it themselves. And here we've got a staff that and system that does it automatically. We have an annual audit every year, so that also helps us make sure. And I think any servicer you consider needs to make sure that gets a financial audit to make sure all the funds are being collected and distributed properly. We also have like a dedicated bank account for our clients' money. So we hold our clients' money for a few days and we spit it out. It's not commingled with our operating accounts. And then we got a professional staff that helps us manage portfolios. We've got monthly meetings with our clients. We do so many reports. I mean, I literally could talk about reports for hours, but we've got a good servicing company should have a big paper trail, great reporting, great staff, and just good, consistent things that they do. And you know what? One of the biggest ones is they should also treat people nicely. We've been getting a lot of loans lately from a company that shall be named nameless, and just because they're jerks, it's like, great, thank you. I love it. And simple things like that make this business work.
It's a small business. It's a small thing. If you treat your clients like shit, people will find alternatives.
That's right. But here's really what servicing's like. We have moments like this with some people that, when we talk about how payments are applied, how interest is applied, how there's days between, hey, if you're 70 days behind, the first thing you're going to pay is 70 days of interest. And some people just don't understand. And we have moments like this where it can be, a tough business. It's really customer service. We have to answer questions. We, especially lately with COVID and hardships, we've literally had to be therapists to all of our clients, our borrowers just going through hardships. But this is more of a joke. It's not to be serious. Okay. Now let me talk about like some pros and cons about outsourcing servicing. And I'll talk about the pros first. And again, if anyone has something I didn't think of, please speak up. I'd love to talk about it. But pros are, I cannot tell you how much money I have spent on software, employees, all the above, overhead, that the people who come up with me for $15 a month, really just benefit off the complex systems we've set up over the last 10 years, and this custom processes and statements and anything that we've done. So you avoid substantial software costs. And yes, there's some cheap software out there, but I can tell you, I've seen it all, and it's not worth you get what you pay for, and it's not worth it. There's also you avoid the learning curve of how things should be done. How do you handle, how do you force place insurance? There's back due property taxes. There's a tax lien on it. What do we do? You avoid a huge learning curve by outsourcing servicing to a good servicer, that is. And you piggyback off our experience and also our network of vendors. We've got attorneys we work with and vendors that, we've got preferred pricing on, and they're really good, and they can handle high volume. I've onboarded loans from other places where, the attorneys should be disbarred, it's been horrible, literally negligent actions. And I think my client ended up suing their attorney for that. Let's see here. So, you avoid a ton of overhead, including staff. And we also, the benefits of outsourcing too is, we have there, I'm in the office right now, and we've got office hours here on Saturdays as well. And, we've got customers, we have a staff, we've got office hours, we've got phones that can be answered and people to answer questions, where the lenders literally for $15 a month can just do that and, do, benefit off outsourcing it. Other pros are, you got a compliance, we got a big audit trail. This is something that a lot of people don't really know what this means. Property tax monitoring. So property tax monitoring, I think people think it just means, oh, you just go to the local tax office and look up, what's going on and pay it when it comes up. We actually have a vendor that helps us, determine every month, are the property taxes zero? Is there a new assessment that came out? Is anything new or anything changed? And hey, when the property taxes are due, what amounts due, and like pay it timely. And insurance monitoring, this is something that we have as well. This is the big one. I mean, insurance management literally is like the biggest pain in the butt for people, because I don't know if anyone on this call has ever had a borrower switch insurances, cancel insurance, or just do something crazy without telling you. And it happens all the time. People switch insurances and cancel insurances all the time. And what happens is the insurance company sends the refund back to the borrower. They don't send it back to us. So we get a notice, and we have a system now that electronically can say, oh, Scott Carson canceled his insurance last week. So we got to call Scott Carson and be like, whatever you do, don't cash that check. But sometimes Scott Carson will say, man, I spent it last weekend with my family. I thought it was free money. And we're like, well, we're going to redo your escrow. We're going to pay your new insurance. We're going to force place it. And your escrow account's about to double. Your payment's about to double. Like, insurance monitoring is one that, protects the ultimate collateral. And borrowers do some really crazy things sometimes, and they spend the money. And we have an electronic way of keeping track of these things to make sure that things are covered. And if the borrower, like, so the electronic database of insurance will notify us, okay, they got a new quote with State Farm, and we'll pay it. However, if they cancel it and they don't have a new quote, we force place it the instant they cancel. So our insurance monitoring is probably like one of the biggest prize things that we do, just to make sure that the collateral is covered. And I think ultimately, I'm not going to beat overhead again, but like stress relief. I mean, avoiding running a business, running the, collecting payments, processing, doing all that we do is a big stress relief if you outsource servicing. Let me talk about the cons of outsourcing servicing. A lot of people think that, hey, I can do this better myself, or I can do it in Excel and save money, and whatever it may be. And for some people, maybe that is the case. It's really up to you. But the cons are, you lose immediate control. And I mean, I've got some clients who say they want me to do things in a bizarre way, or ways they think is better. And it's just like, hey, we've got to have a consistent flow of things that works for thousands of people. And I can't just do it for your one loan, or I can't change the wording on your one statement. I mean, this is like federally approved stuff, So loss of control, certain things may not be to your liking, but like, we as a servicer, we respond, in 24 to 48 hours at the latest. And I think holidays and weekends probably put an impact on our response times, but we're pretty fast about responding. Again, statements may not be worded to your liking, practices may be slightly different, but we've got an overall flow. But again, one thing to consider too is when you buy loans, certain states are different. This is where it's weird, but like certain states, you might have to be licensed to service a loan. You may not be entitled to, oh, it's my loan, I can do it myself. Like, some states allow you to, but some states say, hey, well, if you have more than 5, you got to be licensed. And there's regulatory requirements. You got to keep up to date on changes to local and federal law. And if you're holding escrow funds, you got to be really careful with that with the borrower, because sometimes you got to do refunds. Sometimes taxes and insurance does get lower, and you got to calculate and refund the people. I've got a question here. Does Covey monitor HOA payment status? So there's actually no electronic database like there is for insurance on HOAs. However, what we do for no additional price, we escrow the HOA as well. And we have some clients who have HOA payments every month, quarterly, biannually, or annually, but we prefer to escrow it to satisfy this concern from RJ Santiago. So those are the cons behind servicing. And, some people just want the control. Some people want to do it themselves. Some people want to, figure it out. And, that if that's the case, that's okay. Let me go ahead and RJ, I hope I answered your question. Let me go ahead and talk about some of the avoidable mistakes that I recommend. So when you originate a loan, or when you buy a loan or portfolio, I really recommend reviewing and reading the documents. And if you originate it, your documents should be reviewed by an attorney. Again, I can't tell you the borrower will pay in the closing costs. But even too, if you buy a portfolio and you spend a few $100 on an attorney, I mean, it can avoid tens of thousands of dollars of mistakes. So I think getting a good attorney to represent you, I think, is key to running a note business well. So getting reviewing documents and having new documents prepared by attorneys, I think is key. One thing that we see a lot of is, hey, we get loan documents from people and like, hey, what's the borrower's phone number? What's their social security number? So we can report them to credit bureaus. Like, what's their email address? Not collecting borrower contact info, not asking the seller to provide it. I mean, this is stuff that, one thing I'll say, when you buy a loan, before you give the seller money, that's when they're willing to give you stuff and work with you. After you give them the money, you'll never get a hold of them ever again. See ya. So make sure you get everything you need prior to it. And, borrower contact info sounds so easy, but there's a lot of times we don't get it. We talked about this earlier. Not requiring escrow or being lax on escrow is one that I think could be easily avoidable. Letting borrowers pay their insurance directly. I'm skeptical now, so I don't trust people. So I would not recommend letting them pay the insurance directly. If they're going to pay it, it's not like we make a spread or you make a spread by collecting the funds. It's just, the escrow, the total amount, divvied over certain months with a little cushion, and there's no profits made on the escrow portion. It's actually illegal to make money on the escrow portion. It's really just a straight pass through. Miscalculating the escrow payment. I'll talk about this here in a second. Processing loan payments in Excel. I think we talked about this earlier, how I talked about how there's certain interest calculation methods, and, I think it depends on how you do it, but like it could be inaccurate either in the borrower's favor or in the lender's favor. And Excel it's okay. And if you only have one loan, you might be able to get away with it. But if you start having multiple loans and it gets a little complicated, and you have regular payments, Excel is tough. And this is something I kind of talked about earlier. Whenever you talk about buying loans, your diligence is key. And, never let the seller convince you to make poor decisions. Well, the seller said he's been paying insurance directly. So, or the seller said it was okay in my state that we could charge 25% interest, like whatever it is, like don't listen to the seller. Your best ally is your attorney, and stick to your diligence items and don't cave. You got to have like bankers, rapport and diligence. And if it fits your box, buy the loan. If it doesn't, either get a big discount on it or, move on. There's a lot of bad loans out there to be bought, and I just don't want you guys being one of them. Let me continue on here. So escrow formulas. This is a big one. And I think I'm going to try and just leave here for a second to talk about this. So in this example, so a lot of people will say, well, man, the total escrow obligations, $1,200 a year. Why don't we just collect $100 a month, right? Well, what if the taxes are due next month? We have no money in our escrow account. What if the taxes go up like everything else in the world due to inflation and everything next year? What do we do? And the biggest thing that I can say is, you have to use the last known number. So in this example, the last known taxes are $600, the TAT, total annual taxes. The total insurance, which either is paid at closing or you had the last statement or a premium renewal, you should have a recent number that was used. In this example, it's $600. So total annual insurance is $600. And the total escrow obligation, the TOW, I've spoken about the TOW before. We use this term every day in our office, is $1,200. So there's two things you can do. And one option is if the tow divided by 12 is 100, a 2-month cushion means you could have $200 collected up front into the escrow account. However, that'd be nice. Just a lot of people don't do it. But that would be like option A. Number one is just send $200 to the servicer. And then that would mean the escrow zero cushion would be an accurate quote because you already have $200 in the escrow account. However, what happens in reality is we don't get any money. The borrower doesn't give us any cushion up front. So what you do is you come up with the E0C. So the preliminary, like the escrow payment with no cushion. Then you multiply it by 14 and divide it by 12. So that would pretty much say you add 2 months in a year and divide it by 12, and you come up with a new escrow payment, an escrow with a 2-month cushion, E2C, that's what we call it. And this is how you calculate what the escrow quote should be. And this is just based on last known numbers. Again, sometimes if you have a known number that, okay, next month is going to be $700, you can, like the taxes are due or they're coming up due or you just got an insurance renewal, you can like monkey with these things based on the most recently known numbers. But I think this escrow formula, it's so simple that, you know, once you know the total escrow obligation, you divide it by 12, you multiply the E0C times 14, and you divide that by 12, and this is your escrow payment with a 2-month cushion. I mean, I'm not a smart person, but trust me, this is easy math, and if I can do it, you can do it.
That's the truth, right?
Yes, and this is, so when you talk about a loan mod, I think we talked about earlier, or if you originate a loan, I think this is imperative to quote properly, because what happens a lot with us is we'll get a new loan package and I'll have $100 quoted for escrow. And I'm like, oh, crap. You know, like, how are we supposed to, like, we require a 2-month cushion because trust me, 99.999% of the time, these numbers go up next year, right? And we foot the bill, and we want to make sure that if the borrower is paying, you know, we don't want to make the, because if we don't collect enough money, $100 originally might go to like $200 next year, and you don't want such a drastic increase in these escrow payments because people get up in arms about it. And even though it's not our fault, it has to do with how the payment was quoted from the get-go. Okay. Does anybody have, oh, so I'm sorry. And then you recalculate escrow each year. So there's actually something interesting. Some people think that an annual escrow analysis can be only calculated once per year. And generally that's true. However, there are circumstances that warrant and allow you to calculate it more frequently. And for example, let's say you missed an item. Like, let's say like in Houston, over in Harris County, there's many tax offices. It's not just one tax office. It's a non-consolidated area. So like in most counties and in most places, like where Scott is in Travis County and Austin, Travis County collects for everything: the school, the water, you name it, they collect for the property taxes. In Harris County, in Houston, there's like 120 taxing units, like different offices. There's like municipal water districts, there's ISDs or schools, you know, there's so many different ones that, like, in Harris County collects for a lot of them. But like in Harris County, someone typically has 2 or 3 tax bills to pay. So for example, if you figured out you missed one, you can recalculate escrow. If the taxes increased more than a certain percentage, you can recalculate escrow. There's scenarios where you can do it more frequently, but yeah, like every year you at least have to do it once a year consistently, and we do ours in November. And for most states, most taxes are due like in the fall or in December. They say January in some states, but we pay them in the same calendar year in December, just for like people's income tax purposes. So by doing it in November, we kind of cover the new analysis on the latest tax bill for like over 90% of the U.S. Obligations, maybe more. So David, I hope I answered your question there. So yeah, and what I can do is, I mean, if you, hopefully y'all can like take a screenshot of this, but like I can also email it to Scott. It's really simple stuff. And Scott, if I haven't given this to you already, I need to, and you're welcome to put on your website. I think
That'd be great. Yeah.
we have it somewhere on our website. So let me go to the next tab here. I don't know if I just got frozen or something. Oh, here we go. Here we go. So kind of quickly, I mean, I'm not really a sales pitchy kind of guy, but I think I have to. So what we do is, we, based on kind of how that first example I talked to you about being just really mad about the fees that I was charged from my servicing company early on, I came up with a business model where we just have one simple price. It's just our monthly servicing fee. And, we don't have any setup fees, no laundry list of fees, no conditional pricing. We're only paid when money is collected. And, we have online portals for borrowers and lenders. We got reporting, but like the servicing world is set up in a really bad way, in my opinion, with all these fees up front to everybody. Yeah, no calling fee on the phone. That's right. Yeah, exactly. No, it's a simple model just based on being friendly and nice. And, I'd probably say, based on the clients that we service, we do a good job overall. And I mean, we have some clients who just maybe not like how we word certain things, or don't like that we don't blow up people on the phone after one day of delinquency. But like, we've got a model that works, that's fair for everybody. And I think, the world's becoming nicer. I think you can no longer be, an aggressive business. You have to be a nice business, because if you ever go in front of a judge, because people get sued all the time now, as you know, if you ever go in front of a judge, if you appear as like a nice, friendly person, like, hey, we try to work with this client, he fell delinquent, oh, we started blowing them up with certified letters after one day delinquency. Like, it's just night and day, and we try to be nice and friendly people. So let me answer these questions here, Linda. So we try to keep a decent sized portfolio with our clients, and we're open to starting earlier in someone's business career. And like, we've, for instance, I'm not going to name names here, but there are people on this call who have less than 20 that are our clients, but we know they're going to grow. And, maybe they don't get to 20, maybe they get to 10. But I think we're not good for someone who just has one loan and they're only going to do one in their life. If you're going to do, a couple a year and get to maybe 15 one day, that's great. We'd love to serve you and talk to you. But if you're only planning on doing one and never doing another one again, we're not a good fit. Do I service in all states? So licensing is one, and on our website, I'll pull up our website here in a second, but we're expanding to Arkansas right now. We're entering North Carolina right now. We're in a few states, and I think we need to update our website, but we're not nationwide yet. We're working on growing, and I think the hard thing about entering a new state for us is, we need like a decent portfolio to get in there, because it costs us like $3 or $4 grand to get set up. And if someone has one loan for $15 a month, I'll never make money in that state, and we'll be at a loss. So it just depends. And I mean, if you message me, I mean, I got my email here. Let me know what states you're looking at. I can tell you, hey, I've been asked 100 times by different people, so we need to do it, or we're actually in the application process, or hey, no time soon. I can let you know directly. Let me see. And then here, I've got my information here. Please feel free to call, email, whatever it is you prefer. But, I'm really good about checking my emails if anyone should be an email. But I'm really open to any question of any kind at this time. And, Scott, not sure if you have any experiences with servicers that you want to share that I can comment on.
Well, if somebody's not happy, there's a servicing company that went out there and started putting, if you're going to deboard or transfer to another service, they start charging fees to move the business.
I know.
It's
like a punch in the teeth on your way out. Yeah.
I just think that's so unethical in a lot of cases. Oh, we did a shitty job for you. Here's another $2,000 bill per loan. You know what I mean?
Yeah. No, another one that I've seen a lot lately, and this is one that's so illegal. I've got a client in New Mexico that we're working on onboarding, and we've been working on it for like a year.
Uh-huh.
They've got a decent portfolio. They probably have like 300 mortgages with this a respectable company, not like a bad one, like an okay one. And this company is like refusing to release the borrower's escrow funds to us. They're saying, hey, you got to get every single borrower to have signed notarized documents authorizing us to release the funds.
What?
And it's so wrong. It's like it's their tactic to keep the business. And they're
Oh,
hitting them, and they're also hitting them with a big D board fee. But like as I told my clients, I'm like, hey, like just so you know, the loan servicing rights are held by the lender, like the person on the deed of trust or the mortgage. You temporarily gave them like a lease, like, hey, you can service this for a term, like whatever it is, month to month or 1 year, whatever the contract says.
mm,
And like the loan, all the authorization belongs to you, the lender. And like they're getting attorneys involved. It's like turned into like a big nasty mess. And
oh,
some of these servicing companies just do outrageous things, and like they have no legal leg to stand on, but like they get away with it just thinking that they can scare you. I think luckily for my client, they're like fairly big and they are going to go toe to toe with this client. But for someone like, hey, if you got 1 note, 5 notes, are you going to spend 100 grand suing a servicing company over this stuff? They're hoping you don't, and they're counting on you don't. And that's one of the problems with these servicing companies is they'll fee you to death, they'll play games with you. And honestly, like, you got to remember, like, these rights are held by the lender, not by the
mhm.
servicer.
And they're supposed to work on your behalf. You don't work for them in a lot of
The
cases.
fiduciary, I guess, means nothing. That's right.
uh, good time. Now you also talk a little about Sombrero, because we've got Arnie Averson coming on to talk about Texas tax sales, stuff like that. Talk a little about Sombrero with what you guys do over there too, because I know we got some folks that are interested in that aspect.
Yeah, so the tax lien business that we're licensed to do here in Texas, it's unique to Texas. It's called a tax lien transfer. It's like a property tax loan. And unlike tax sales, where like they will buy properties from the tax sale, and I don't know. I mean, I have my opinions about it, and I just don't think I want to respect your next presenter's stuff on it. But there's some pros and cons to it. And I think in 2008 or 9, I think that business was different. And I can just tell you this, like my sombrero business was different. Like, like in 2012, it was like a night and day difference today. Today, it's really hard to do those loans. The cost of acquisition is super high. I'm actually thinking about getting out of the business just because it's just too, not that it's competitive, but the tax office offer more payment arrangements now than ever
Yep.
before.
Yep.
You have those housing assistance funds that are coming in, helping people pay their delinquent property taxes. So it's nowhere near the volume as it was before, but it's a good business. I mean, the problem is you have to you have to be licensed, you have to
Yep.
market, you have to get the people. Literally, it's like a closing a mortgage loan. You have to
Yep.
look at the title, you have to get loan documents prepared, and you've got to just comply with the laws that apply to that business. And then once you close the loan, people have a 3-day right to rescind, which they do sometimes.
Mhm.
And then you got to fund it, get the taxes, you get a tax lien transfer from the tax office, and that's your security instrument. But it's a tougher business now, and
Mhm.
anyone who's interested in the tax lien business in Texas, I'm happy to share with you my experience. But what Arnie's doing with the tax sales is they would buy the properties that we would ultimately auction off.
Mhm.
And one thing to be, if you guys are interested in buying properties, I would recommend you only buy the properties that are non-homestead in Texas,
Yep.
because the homestead ones in Texas have a 2-year right to rescind the sale. So you might buy a property today and the prior homeowner can come back and take the property back. Sure, they pay a penalty, but they'll come back and buy the property, and you have, like, against your wishes, and you're kind of shit out of luck.
Yep.
And any expenses you put into it, you may not get back. If you
Yep.
rehab it, you improve it, it could be a big problem. So it's a tough business. But I'm not one that looks at properties at the tax sale just because they've gone through so many filters.
Yep.
But every once in a while, something good comes up. Like, Scott, you may not know this, a handful of years ago, Bass Pro Shop here in San Antonio was auctioned at a tax sale. A guy I know bought it for $4 million in delinquent
Wow.
taxes. And in commercial, they had a 6-month right to redeem for a 25% penalty. And Wells Fargo, as a lien holder, had the lien holder and prior property owner has a right. And the lien holder came back and paid this guy $1 million. And that's the only successful one I've ever heard of out of the many, many tens of thousands that have ever happened. And I think it's, there's a lot of cobwebs that comes with those
Yep.
purchases. And,
Yep.
there's no warranty, there's no guarantee. It's as is. And, it sometimes can be very messy, but that sale that I was talking about, that was in like 2013, coming out of the Great Recession, when I think these types of things happened of quality.
Yep.
Nowadays, it's like finding a diamond in the rough. It's very rare that an item of quality comes up on a tax sale.
Yep. Exactly. T asked a question here. Are there any red clauses or red flags to look for when reviewing a contract with a loan servicer?
Yeah. Yeah, absolutely. I think you got to get a good understanding of their fees and their processes. Because I think we alluded to some early termination fees that are like those gotcha. Hey,
Mm-hmm.
yeah, you're welcome to move, but go screw yourself. You got to pay all these fees. And there's also all these conditional things and all these things. Like you got to understand, what are they going to do for you?
Yep.
Do they want you not to call them and you just be an MIA investor and they'll just handle your money for you and pay themselves and do things? If that's what you want, just make sure it says that. Or if you want to be involved and you want to have an understanding of where money's in, where money's out, and you have to authorize things, definitely make sure it says that. I think I've seen all sorts of different varieties of things, and you just got to talk, negotiate, and get what you want, and make sure it fits you. But I think a scope of work, scope of communication and reporting, and authority to do things with or without your approval, and all list of fees are what you should keep an eye out for.
Mm-hmm. I also think it's important to look at how communicative the borrowers can be with the servicing company. I mean, how easy is it to get somebody on the phone to answer questions? Because there's been, when we bought notes in the past where the existing servicer was horrible, and that we actually said, okay, we'll buy more from the seller because their service is horrible, because we know if we just reach out to the borrower and just say hello to them, we've probably got a 60% chance to modify or reinstate that borrower with just a phone call.
Yep.
You know what I mean? So
it's like all things, the little things are what make it all work out well. If you just focus on like some big things, sending statements, or just little, just focus on things. I mean, it's a culmination of all the little things that make a service good or a business good.
Yeah. Well, and it is especially when I've been in business, as a note investor for 15 years, and servicing companies come and go, and some are really focused, and then it becomes a money grab. Then it becomes, how the clients work for the guy that, or the person that owns the servicing company, versus it being the other way around. And that's the thing. You put the service back in servicing. That's why we label this, because you've asked questions, and you were always saying, hey, let's do this. Let's take a little bit extra step here. Let's call this. Let's do this thing. And that is not the case. Not all servicing companies are created equally out there. And I really love your business model, your business plan, what you do. And you got fans here. Larry's bragging on here in the chat roll for everybody. He says, let's see here. What did he just say? He's, all I can say, Covey Finn is the best servicing company. And whenever I can, I will 100% move board my notes with them. I've been 1,000,000% with Covey, but more importantly, with Eric. I'll print that out and send it to you. You can use it as a Yelp review. How's that sound?
I love it, Larry. I mean, there's times where, we try our best to do the best. And I mean, there's only so many things we can do. And I think what our difference is, we'll make a level of effort. Mm-hmm. And, if we ever, there's times where we mess up. I mean, there's no doubt that maybe one of our, we're human, and one of our staff members forgot to do something or didn't respond to you. And
it happens.
The moment anyone figures out that we forgot to do that, we have about 3 or 4 higher up people make sure it gets fixed. And I think I'm not going to say we're perfect. I mean, I'm not in any way, that person. I don't walk on water, but we try really hard. And if we mess up, we'll own it and we'll definitely fix it as quickly as possible.
Or one thing I love is the solution aspect of things. If it's something you guys can't do, like you don't handle the legal, you're not giving legal advice, stuff like that, but you're like, hey, reach out to this person or reach out to this person. Or like we talked about that portfolio of Arkansas notes that Catherine and Lauren and we're working on a while back and trying, okay, how can we make this work in different ways? And it's always good to pick your brain and stuff like that on different transactions, portfolios, make some things happen. So
yeah, I mean, hey, I mean, I'm here as a resource. I mean, I'm here to serve my clients. And Larry, I think he and a few others have actually taken me up on that stuff. And like, I'm not going to tell Larry what to do, but I can just point out some things that I've seen that I've personally been involved with. And if he takes me up on it or not, that's up to him. And and I think luckily, I mean, I think he knows pretty early on that I'm not BSing him. Like I've got no skin in the game for him to make a bunch of money or not. I'm just here to service his loans. And if his servicing goes well and his clients do well, like that actually makes my life easier. So it's good. We're on the same team.
Yeah. Well, David asked a question. How do you, what did he say here? How would we find whether the borrowers are satisfied with the servicer or not? So here's the thing. Every servicing company's got a phone number. Call a number. It's one of the things that we did. We saw on the servicing notes, because that's what you should be requesting as part of your due diligence, see what's going on, and saw statements and stuff like that. So we picked up the phone and called and acted like we were the borrower calling in, and it took forever to get a hold of somebody to talk to. And I couldn't imagine, because you got to realize if you're buying non-performing notes, you're, especially lower balance stuff, it's probably not the most financially savvy individuals out there. I mean, if somebody doesn't have a debit card or a credit card, they're probably using money orders. Well, they want to set up payments. And a lot of times with folks that are working hourly, not making much money, just adjusting the payment date a lot of times can help people. And we saw that with one servicers. This bar was consistently late. We reached out to them. I'm like, listen, I would love to. I just need to change my payment date to the 8th instead of the 4th, because most of the time the servicing company is trying to pull a payment out and saying I'm late and I just don't have the funds yet, haven't cleared my account. So I can set this up, but I just need a little help. One little change, 5 minutes was fixed, and that bar has been on track since. You just got to talk to the bar a little case, and a lot of people don't want to talk to people. And in servicing, you got to talk to people, I think, more than anything else.
Oh yeah, and I answered David's question. David, to figure out borrowers are satisfied or not. Like, I recommend you as a lender. You should have some level of interaction with your borrower and check in with them once a year, whatever it is, however often you want, and asking your own borrowers what they think. And sometimes, if they're bad actors and bad payers, like of course they're not going to say nice things, but if they pay well and they have an honest review, actually they're terrible, here's why. It's hard to pay them, and I figured it out. Okay, that's a genuine review. But online reviews are really helpful. I mean, I like looking at them, and granted, a lot of online reviews, are real, some are not. But talking to your own borrower, reading online, that's a good way to get real feedback.
Yeah, exactly. Now, where I'm going to ask this question, I know you don't have a crystal ball. Where do you see opportunities? Where do you think is the number one, number two opportunities for note investors over the next couple of years? I know if we had a crystal ball, we'd be at Vegas.
Of course. Yeah. I buy a lotto ticket right now.
Right.
So note investing is really tough. And I mean, I have my moments where I think I'm going to make all the money in the world, and I've got moments where I think I'm going to go broke. It's a tough business, but I think, I see a lot of people have success. And I think marketing is huge in this business. And what I mean by that, Larry's figured out a good SEO way, and SEO is pretty good. And he also does the click mail, which I love. I think that's great advice for people who don't direct mail. I mean, what's that? There's a lot of other panelists, big banks on this thing that market heavily to deed of trust holders and note holders. And there's a way to buy data from certain companies to say, hey, I want a list of all the mortgages, take out banks, take out blah, blah, blah. I just want individuals or whatever. And you can sort them by loan size and maturity date. Okay, these loans are maturing soon. I'd love to buy these notes. And that's how a lot of people do it in the business, in addition to SEO marketing. But I mean, I think the trick is there might be some good opportunities here as interest rates rise and people have got some low rate loans they want to just liquidate and cash out for a fraction. But it's hard to say. I mean, I would focus on like the good metro areas of the world, make sure your diligence is good and market heavily. And like what I'll say is stick to your guns on diligence. Just because you have a deal and you haven't really heard much, don't cave on your items. Like just make sure that you buy the loan for the price you want and the yield you're looking for. And a great way to do loans too is talk to realtors. Try to originate loans. In your local community, just say, hey, if someone ever has a hard time getting a mortgage and they're good people, let me know. And that's a good way. I mean, right now loan rates are higher, 5-6% for a 30-year. As a private investor, you might be able to sell it at an 8 or a 9, borrow some money from a bank and make like a double-digit return.
Yeah, I love it. I love that strategy. I think it's a phenomenal thing, especially a lot of tired landlords don't want to be in the landlording business anymore, but would be glad to sell owner finance a deal to you. And I think it's one of the best strategies out there now. They don't have to take a huge tax hit in an owner finance deal versus a traditional sale in a lot of cases too. I think that's some opportunity to pick up some debt that pays well as well.
Yep.
I love it. Any other questions before we let Eric get back to his Saturday? This has been great, Eric. Thank you so much for coming on.
Hey, I love doing this, Scott. Yeah, anytime. Let me know.
Will do, buddy. Well, I will. I'll shoot you a text message here in a few minutes with the details for next weekend. We'll go from there. All right, buddy.
Wonderful. All right, everyone have a good Saturday. Thank you, Scott.
Thank you. Thank you very much, Eric. All right, everybody. Hey, don't go anywhere. We've got just our next speaker coming up here in just a second for part 2. If you tuned in yesterday, you had your mind blown from Merrill Chandler. Now, this session is a little bit different. He's going to be sharing how to use insider banking to help you in your investing advantage. Stay tuned. We're just going to take a quick, short little break so you guys can run to the restroom, grab a fresh cup of coffee or whatever. But he'll be on our next speaker here at Note Camp.